All right, let's just dive right in because today we are looking at a structural supply chain failure that is quietly turning the entire fast food industry completely upside down. Now, if you've been watching the stock market lately, or honestly, even if you're just driving past your local drive-thru on the way home, you've probably noticed a massive push for discounts, $5 meals, crazy app deals, you name it. But beneath all those flashy marketing campaigns is a pretty brutal mathematical reality. So today, in this explainer, we are completely deconstructing what we call the protein margin arbitrage. The core thesis of our entire analysis really comes down to this one idea. McDonald's is fighting a price war with Burger King, but the cow is winning. While everyone out there is hyper-focused on these fast food value meal wars, we actually need to look strictly past the retail marketing. The media absolutely wants you to think this is some strategic battle for market share and consumer foot traffic. But the truth? It's a race to the bottom. And it's a race to the bottom because these underlying input costs are completely out of control. And this brings us to the urgent catalyst that makes this topic so critical to understand right now, negative 28%. Shake Shack recently saw its stock absolutely plummet by 28% right after their earnings call. This is the definitive news trigger. It proves exactly what happens when a premium brand simply cannot effectively hedge its primary commodity, which in this specific case is high-quality beef. Now, this central problem reveals a really fascinating paradox. Think about this for a second. On one hand, Shake Shack reported record revenue growth. We're talking over $366 million, which is up 14.3%. They actually beat top-line expectations. But despite all that money pouring in, this still swung to a negative net income. They literally lost $300,000 for the quarter. So how does a company achieve record-breaking sales volume and still lose money? Well, the answer is soaring beef prices. The cost of their primary ingredient rose in the high teens during that quarter, which completely erased all of that top-line success. So here is our roadmap for this explainer. We'll start by uncovering the fast food margin illusion. Then we'll break down the anatomy of burger COGS. From there, we'll look at the biological reality of the cattle supply cliff, how it creates a franchisee OpEx squeeze, and finally, the alpha, how sophisticated investors are actually trading this data. Let's start with Section 1, the fast food margin illusion. We need to break down the dangerously flawed assumption that higher sales volume from value meals automatically equals higher profits. Wall Street analysts completely miscalculated the persistence of beef cost pressures here. Despite hitting that $366.7 million in revenue we just talked about, Shake Shack missed the earnings per share consensus by over 100%. Analysts expected a 12-cent profit per share, and instead, they got a 1-cent loss. The market punished them instantly, dropping the stock right toward its 52-week low. Why did this happen? Because the market suddenly woke up and realized that selling more burgers doesn't actually help if every single burger you sell is actively eating away at your profit margin. So the absolutely crucial point here is this deep divide between the retail narrative and the brutal truth. The retail narrative tells investors that aggressively priced $5 meal deals are going to drive foot traffic and basically save the day. But the brutal truth? These value deals destroy EBITDA margins, earnings before interest, taxes, depreciation, and amortization. When beef prices are surging, discounting your food means you are operating in a negative margin loop. You are essentially paying your customers to eat your food. You're actively burning cash for the sake of revenue vanity, which makes it a highly self-destructive strategy. To truly grasp why this margin destruction is happening, we have to transition to Section 2 and look at the technical anatomy of burger COGS, or cost of goods sold. Picture a simple ice cream stand. Step 1, money comes in. Let's say you make $100 in total revenue for the hour, but you don't get to keep that. Step 2, you immediately have to subtract the wholesale material costs. In our analogy, that's the ice cream. For the restaurant, obviously, it's the raw beef. Only after you pay for those physical materials do you move to Step 3, which is subtracting your employee wages, your rents, your overhead. Step 4 is whatever is finally left over, your actual net income. Now, if the cost of your raw materials skyrockets by 32%, which wholesale beef literally has since 2023, that middle layer expands massively. It instantly wipes out the net income at the bottom, even if your total top-line revenue stays exactly the same. Now, watch how this builds when we scale the analogy up to multinational corporations using what we call an input sensitivity rating. Shake Shack faces extreme exposure because beef makes up an estimated 25 to 30% of their COGS. And why is that? Because their premium patty is over 3 ounces. Now, compare that to McDonald's. McDonald's has a moderate input sensitivity. Their standard patty is barely over 1 ounce, and they possess this unmatched global scale. They literally rear millions of cows internally to smooth out supply and price shocks. So every single cent that cattle futures rise hurts a premium brand like Shake Shack 3 times as much as it hurts a scaled giant like McDonald's. Okay, moving to Section 3, the cattle supply cliff. What is actually driving the cost of beef so high? Let's step off the restaurant floor and onto the commodities trading floor. 86.2 million head of cattle. That is the current size of the U.S. cattle herd, and it represents a staggering 75-year low. Seriously, let that sink in for a moment. We have not seen domestic cattle numbers this tight since the aftermath of World War II. And this massive contraction isn't some accident. It is the result of a vicious combination of prolonged severe droughts completely ruining pastures, sky-high interest rates, and soaring feed costs that literally forced ranchers to cull their herds just to avoid going totally bankrupt. And here is the reality check. You can't just flip a switch to print more cows. We are dealing with a strict biological lag. From year 0 at conception to gestation and birth in year 1, all the way through the growth phase in year 2, it takes roughly 2.5 years before that animal enters the food supply. Because ranchers sold off their breeding heifers during the drought, this supply cliff guarantees that we will have structurally tight supplies and high prices through at least 2027. The shortage is fundamentally, unalterably baked into the biology. This structural scarcity is heavily reflected right now on the Chicago Mercantile Exchange. CME futures for feeder cattle and live cattle are just holding at historic highs, with market sentiment remaining overwhelmingly bullish due to this incredibly tight supply. The wholesale cost has become so oppressive that even massive industrial protein processors like Tyson Foods recently reported over a $300 million operating loss specifically on beef. I mean, think about that for a second. If the giant slaughterhouses are losing millions of dollars producing the meat, what chance does a fast food chain have of buying it cheaply? Zero. Now, you might be wondering, well, why don't investors or companies just hedge against this by buying paper commodities, like an ETF? Welcome to the contango trap. Contango is a market structure where the futures price of a commodity is higher than the current spot price. If you buy a futures ETF, the fund constantly has to sell expiring, cheaper contracts just to buy the next month's more expensive contracts. This creates what's called a negative roll yield. Month after month, that rollover slowly bleeds your capital dry. It's a brutal truth to understand. Long-term passive investing in a contango commodity market essentially guarantees capital destruction. You just cannot outtrade the math. This brings us to Section 4, the franchisee OpEx squeeze. This whole commodity squeeze creates a devastating ripple effect downstream, completely changing the math for local restaurant owners. Local franchisees, the actual everyday people running the restaurants in your town, they are currently getting crushed by what we call a triple threat. First, they're dealing with 20% plus inflation on beef. Second, escalating labor shortages and wage hikes. Third, continuously rising credit card swipe fees. But the real kicker? Corporate mandated value pricing. The corporate parent forces the local owner to sell a $5 value meal to drive brand traffic and look good to Wall Street, but the local owner is the one absorbing all the record high food and labor costs. They are entirely trapped. And this desperation brings us to a fascinating real-world consequence: the death of the free refill. You've probably noticed fast food chains quietly phasing out self-serve soda fountains in their dining rooms over the last year. Why are they doing that? Because beverages operate on an incredible 80 to 90% profit margin. Historically, drinks were the financial buffer that subsidized the razor-thin margins on the burgers. With beef costs completely destroying food profitability, franchisees can no longer afford the OpEx leakage of customers pouring their own free refills. They have to protect every single drop of that beverage margin just to keep the lights on. Finally, Section 5, the alpha. So what should you actually take away from all this data? How do sophisticated investors turn this structural supply chain failure into an actionable market strategy? Let's get into it. First off, we identify the short targets through competitive tiering. We look for vulnerable challengers. Take Wendy's, for example. Their stock has seen a massive 50% downward trend over 2 years. Why? Well, because their entire brand identity is rigidly built on fresh, never frozen beef. In a historic supply shortage, that strict marketing requirement prevents them from using cheaper frozen imports to blend down their costs. A catchy slogan literally becomes a massive supply chain liability. And of course, there's Shake Shack, our pure play premium target that dropped 28% simply because of their massive, highly sensitive patty size. The play here is pretty clear. If beef is the short, poultry is the long. The smart money is executing a deliberate sector rotation, shorting the cow and longing the chicken.
Because beef has essentially become a luxury item, consumers are trading down to chicken, which has a much faster biological production cycle and way cheaper feed costs. So investors are shorting the high beef to revenue fast food chains, and they're rotating that capital into industrial chicken infrastructure and into consumer plays like Wingstop. Companies like Wingstop bypass the beef crisis entirely. They operate almost like tech platforms that just happen to sell chicken.
As we wrap up this explainer, I want to leave you with a provocative thought. Fast food conglomerates are, at their core, massive real estate empires masquerading as burger joints. They make their real money collecting rent from their franchisees. But if the cattle supply cliff lasts for years and the forced value meal creates a permanent negative margin loop that bankrupts the local operator, what happens to the multi-billion-dollar corporate empire relying on their rent? Keep an eye on those input costs, folks, because the cow might just bring the whole house down. Thanks for joining me on this deep dive.